Hello, everyone, and welcome to Business Basics. It's the series where we talk about financial markets and various accounting practices. That way, you get the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our series. Today's episode is going to be dealing with debit versus credit. And no, it's not debit and credit cards. It actually has a different meaning, and it's related to accounting and the method of double entry bookkeeping. And what double entry bookkeeping in accounting terms means is that for every debit, there is an equal and opposite credit, and for every credit, there is an equal and opposite debit. Now, you may be noticing that I'm playing off of Newton's third law of physics, and that's intentional because that's signifying that debit and credit are equal and opposite. So they have to have the same dollar amount, but they're of opposite metrics. Why do we want to look at accounting? Well, previously in this series, we focused a lot on investing. But whenever we've looked at some of the methods that are there to evaluate an investment, you have to be able to read a company's balance sheets, income statements, and be able to reasonably project growth, etc. In order to do that, you have to have a basic understanding of accounting. And accounting fundamentally shows us how a business distributes money. And that is what is very important for us to understand. If we understand how businesses report and record their information, then we can figure out how the business is paying their employees, how the business is investing its capital, how much money it's receiving from investors, how much money it's raised in debt, how much money it's getting in sales, and etc. And this is why we have to understand the basics of accounting. And with the basics of accounting come double entry bookkeeping. And that means that for every transaction, there's one debit and one credit. Debit and credit are exact opposites. And every account, so for example, sales is an account. That is a debit or a credit. And to tack onto that, whenever you look at an accounting sheet, the left side is usually going to be the debit side, the right side is going to be the credit side. So let's look at an example to help you understand exactly what debit and credit is. So here we have two different accounts, cash and revenue. Let's say that I am the business owner of fictional company ABC. And fictional company ABC has a certain amount of cash and a certain amount of revenue. So as we discussed, the left side is debit and the right side is credit. So here we have the cash account showing how much cash we have, and here we have a revenue account showing how much money we've made. Now let's say that I sell $10,000 in goods. You'll notice here that the $10,000 is put on the credit side. And you may be wondering, wait, why is that a credit and why is it not a debit? How do I know which is which? And we'll get to that later. But this is just to show you that for every credit, you have to have an equal and opposite transaction. So you have to have a debit. So for this $10,000 that's credited to the revenue account, you have to have $10,000 debited somewhere else. And that $10,000 can then be debited onto the cash account. Say you got $10,000 in revenue, and then you decide to put that $10,000 into your company's cash pool. Well, then because it's credited on the revenue side, then it has to be debited on the cash side. Now, let's find out, how do we know where to debit and where to credit? And here it's showing one debit on the left side, one credit on the right side. So the way I first learned it, and the way I'm going to teach you guys to do it, is to use this acronym called DEALER. DEALER stands for dividends, expenses, assets, liabilities, equity, and revenue. You draw a line straight down the middle of the word dealer, so between the A and the L, and that splits it in half, and that tells you what side is debited and what side is credited. So dividends, we talked about dividends earlier on the YouTube series and podcast, and dividends are if you invest in a company, the company sometimes has a profit, and sometimes it decides to reward its investors by giving its investors some of that profit that they got in dividends. So any dividends you or your company receive from your investments, those will be debited. Expenses are also debited. So for example, paychecks. you pay your employees, and those payments that you have to make are debited because they are expenses. Also, if you have to upgrade equipment, then the cost to do that might be considered an expense. And then finally, assets. Those are also debit accounts. And assets are anything that provide value to your company. So if we think back to our previous example with cash and revenue, we saw that cash was debited. So where might cash fall then under dividends, expenses, and assets? Cash is an asset. So that's how we know that it's a debit account. Other examples of assets might be a manufacturing machine that you purchase. That machine provides value because it speeds up your manufacturing process. So that's an asset. And the cost to run that machine and to purchase that machine are also filed as assets in accounting. Now let's look at the other side of dealer. Liabilities. Liabilities are anything that you or your business might owe. For example, let's say your company decides to buy a manufacturing machine to speed up its process of manufacturing. That way it can get customer satisfaction higher, and it can also produce more goods in a shorter amount of time, leading to more revenue. But say you don't have the money then to pay for that manufacturing machine. So what you decide to do then is to either take it as a loan. Say the company that you buy the manufacturing machine from, you say to them, "I'll buy it on credit." And what that means is you owe them the amount that you paid for it plus interest. So liabilities are also sometimes known as accounts payable. And accounts payable is anything that you owe to someone else. So this, in other words, is debt. Equity. You might also see equity sometimes written as shareholders' equity. But in essence, equity is the amount of money that you have that's invested into your business. For example, if you're a business owner and you are courting investors, you might say to that investor, "Give me X amount of money and I'll give you X percentage of the company." And that's how all investing works, right? Whenever you buy a stock, say you buy Tesla, you buy one share of Tesla. Well, you would buy one share versus however many shares they have total, and that would be equal to your percentage of the company that you own. You have that equity in the company. And so that is, in essence, what equity is referring to, investments. And then finally, revenue. Revenue is money that your company makes from selling something, and or any money that your company brings in. So the best way to practice with dealer and practice with debit and credit is to do it with examples. So on the next slide, I have a few examples that we're going to practice with. And the way it's going to work is I'm going to say the account name, and I'll leave a few seconds for you guys to formulate an answer, and then I'll explain the reasoning for why a certain account is a debit account or a credit account. Okay, so cash. Now we did cash earlier, but I think it's good for you to see how cash is related to the dealer equation that we just learned. So when we say cash, we're talking about pure physical cash that your business might have on hand. So what part of dealer is cash? Cash is an asset, as we discussed earlier. So therefore, because assets fall on under debits, then we know that the cash account is a debit account. Okay, now let's look at rent expense. And notice how I've capitalized the expense word. So what that should give away the answer immediately, because that tells you that expense is a debit account, because the first E in dealer, falls under the debit side, and that first E stands for expenses. Okay, now we have a list of 10 different accounts that we're going to do. So store equipment. What is store equipment? Store equipment is an account that would be debited, and that is because store equipment is an asset. So for example, let's say the cash register that you use to process payments. That register speeds up transactions, or it organizes transactions for you. And that process of organizing the transactions is something that provides value for your company. And because it provides value for your company, it's an asset. And we know that all assets are debit accounts. Now let's look at merchandise inventory. Merchandise inventory is also a debit account. So let's say that you sell clothes, you sell t-shirts beforehand, so you might buy blank t-shirts to begin with. Now those blank t-shirts, those are what you're using to sell, and those are what are known as your inventory. And inventory is something that will in the future, or maybe even right now, provide value for your company. So merchandise inventory is also an asset. And because of that, we know that because it's an asset, it's a debit account. Now let's look at sales. What are sales? Sales is a credit account. Sales refers to the money that your company takes in from selling something. What does that sound like? Well, sales is a loose synonym for revenue. Therefore, we know that sales is a credit account. Okay, accounts payable. We talked about this earlier, so let's see if you can remember. Accounts payable is a credit account. Accounts payable is what you owe to someone else. In other words, it's a liability. And liabilities, as we know from dealer, are credit accounts. Okay, the next one is a little tougher. Capital. What might capital be? Debit or credit? Well, capital is a credit account, and capital actually refers to money that you bring in from investments. So, if an investor puts in money into your company, the money that the investor is giving to you is what is known as capital. And in essence, that capital is shareholders' equity. And shareholders' equity we know is a credit account. So capital is also a credit account. Now the drawing account. Is that a debit or credit account? You might be wondering what drawing even is. Let me tell you this. Drawing is the exact opposite of capital. Capital is money that comes into your business via equity. Drawing is money that's removed from your business. So when an investor sells their shares from your company, they sell their stake, then they're taking money out. And drawing refers to the money that's being taken out. And drawing isn't exactly referred to in any part of dealer. But the way we know what drawing is, and it's a debit account, we know that drawing is a debit account because drawing is the exact opposite of capital. Because capital is a credit account and drawing is the opposite of capital, drawing's categorization has to be the opposite of capital's categorization. So therefore, drawing is a debit account. Now let's look at accounts receivable. Is that a debit or credit account? Accounts receivable is a debit account. You might be noticing that receivable and payable seem like the opposite, and that is exactly true. Accounts receivable might be something that you loan to another business, and that business then owes you. So, because it's the opposite of accounts payable, accounts receivable has to be the opposite of credit. So, therefore, accounts receivable is a debit account. Transportation in. This one's a little harder. Give it a go. Transportation in is a debit account. You know this because transportation in is referring to the money that it costs you to bring in certain items. For example, let's say with your t-shirt business, you have to get your t-shirts sold. You customize them at wherever your headquarters are, but then you have to send them to whoever you're sending them to. Now, how do you get it to those customers? Let's say that you fly it. Well, flying any item has costs associated with it. Let's say you use a trucking company. That also has costs associated with it. So that transportation cost is the cost that's being referred to in transportation in. And there are two ways of looking at that transportation in account. One is that it's an expense. It's a shipping cost, essentially. It costs money against your company. The second way of looking at it is it's providing value to your company, in that it's a way of getting your product to customers. Regardless of whether it's classified as an expense or it's classified as an asset, transportation in is a debit account. And for the record, in most professional accounting, transportation in is considered to be an asset account. Now let's look at purchases discounts. Let's look at the first word of that, purchases. I think purchases here refers to the money that you spend to buy something that you can then use for your business. So with your t-shirts, purchases might refer to the bulk order you give to buy the blank t-shirts. Now, what are purchase discounts? Discounts might be discounts the company you bought the blank t-shirts from gives you for buying in bulk. So let's look at those purchases then of the blank t-shirts. Those purchases are assets because those blank t-shirts provide value to your company. But discounts are the opposite of that. So if we know that purchases are a debit account, then the opposite of that, which is purchases discounts, then must be a credit account. Now finally, let's look at office supplies. What are office supplies? Office supplies are a debit account. We know that because office supplies are things that can help your business with, for example, a printer. Printer allows you to write something that you see on a computer on paper, and that might provide value for your business, so that's an asset. Okay, so what next? Well, if you're interested in learning about investing strategy, business books, or even accounting books, then I urge you to go to our blog. And over there, you'll see lots of book reviews. And if you want some business reads, for example, learning about dividend dates, etc., then also make sure you sign up for a newsletter over there. Also, be sure to follow our podcast. Our podcast and our YouTube series cover similar topics, but they're not always the exact same. So be sure you check out our podcast. And also follow us on Instagram and Twitter for business articles and business basics updates. And don't worry, all these links are in the description below. Make sure to subscribe and hit a thumbs up button if you like this video. This is Project Business Basics, and thanks for watching.